Ask Abby, providing answers, insights, and education designed to give you the tools and knowledge you need to thrive financially and live confidently in retirement.
And welcome back into Go Ask Abby with Abby Reed, co-CEO of the Reed Financial Group, the retirement family. This is your opportunity to get information and education on important financial topics and, as always, ask your questions. If you've got something on your mind from a financial investment or retirement planning perspective, go to the website, goaskabby.com, submit your question, and you can hear it addressed on air with Abby Reed, our resource for a common sense approach to planning. Abby, always a pleasure, and today going to be talking about the important impact of these rising interest rates that we're hearing so much about.
That's right, Peter. One of the top questions that we're seeing right now, everybody is wondering, how is this going to affect me? How is it going to continue to affect me? Why is my portfolio behaving like it's behaving? And all of those questions have to do with this topic. So it's a great one to go over.
Well, rising interest rates actually affects and impacts a very broad range of different financial effects and implications. And we want to talk about that in just a moment. But why are we seeing interest rates on the rise, and how are they going up?
So in general, interest rates really haven't been that big of a topic. An exception is this year, obviously. So they were low for quite a while, which stimulated quite a bit of economic growth. And that's what we saw before this year for the past, at least 5 years, maybe even 5 to 10 years. So what's changed this year is because of what happened during the coronavirus, interest rates were slashed. They were cut to bare minimums. And that made a lot more liquidity be pumped into the economy. Also, the stimulus checks, a lot of different things went into that. But in general, there was just a lot of money in the economy, and things were booming. They were pretty good before that. And then all of that excess money just kind of propped it up. We were probably at the tail end of that market cycle anyways. And then with the coronavirus, it propped it up for a couple more years than it probably would have been anyways. And so as we've seen that taper off, that's where we saw inflation. So inflation was a little bit hotter, as they say, or a little bit bigger than they expected it to be. And so this is the Fed, who is tasked with a couple of things, mainly that being controlling inflation. And so as those readings continued month after month, as we saw gas prices skyrocket, grocery costs skyrocket, travel skyrocket, things were getting back to normal, and everybody was going out and doing things that they weren't able to do or want to do for the past couple of years. So prices really shot up. And so to combat that, so that we don't plunge into a recession or depression, the Fed is the organization or the controller of that. And one of the ways they fight inflation is by increasing interest rates. And so what they've done is raise interest rates at every single one of their meetings this year. There are 2 more opportunities for them to do that this year, and then a whole set of new opportunities to do that next year. And they've been very clear that one of their number one priorities is to get inflation down. Their goal rate by the end of 2022 is 4.4%. So we've got a little bit of room to go to get that. So I think it's pretty fair to expect continued interest rate increases throughout this year.
Now, according to the last report, most recently released data, inflation actually came in hotter than expected. So we probably are going to see them on their charted course continuing to raise interest rates throughout the end of the year. What all does rising interest rates impact and affect? Because we seem to see a lot of things that maybe we weren't aware of the connection.
So rising interest rates affect so many different things, and it affects everybody, really. It's not just people that are in the retirement phase of life, or planning for retirement, or have a significant amount of their net worth in investments. It affects everybody.
Although it may affect retirees more than those that are in their working career, correct?
Yeah, exactly. It affects them differently, and the stakes are also a lot higher for retirees or those that are right at the cusp of retirement. So the different areas in general that rising interest rates and inflation affect are mortgages and the housing market in general. So that's going to affect almost everybody, whether you're a homeowner or a renter. That's going to have some kind of effect on you. I'm seeing that right now. Personally, I was looking around at some new houses to potentially move, and it's just a very different housing market than it was even 3 months ago or 6 months ago. So that's definitely one area that it's affecting, and we'll get into the details there in a little bit. Bonds, so the traditional more conservative part of the 60-40 portfolio. Rising interest rates have a huge effect on bonds. And that's a really important discussion for people that are on the cusp of retirement or in retirement. Just being aware of the effect that has on it. Also savings. So what does that mean for our money that's just kind of sitting there, our emergency fund or money markets, those type things, CDs, those type of instruments. Debt. So how is this going to affect, just like the conversation about mortgages, how is this going to affect my credit card, or if I want to go out and purchase a new car and I don't have the cash to pay for it, what's the effect of that on those choices that I have to make? Investments, of course. So stocks, mutual funds that have stocks, those type things. It also affects that. And then last, but certainly not least, is pensions. So most people don't necessarily have pensions anymore, but for those that do, that's probably going to be one of your biggest assets in retirement. And it's really important to understand how that works and how rising interest rates will affect your options this year and next year. So we're going to get into that as well.
Now, Abby, you shared an article with me on this pension discussion, and the article stated that as interest rates are on the rise, it is a strong likelihood that those that are facing the decision of how to take their pension are likely going to see the lump sum reduced. Can you explain why this is?
Yep. So that's something that, again, we haven't really seen in the past several years. So most people aren't aware of it. And it's a really important thing to understand especially if you're thinking about either retiring this year or maybe even at the beginning of next year, and you have a pension and you have a lump sum option on that pension. So because of something called the equivalent portfolio value, meaning how much is this amount of income, so your monthly income, if you chose that option on your pension, how much would that basically cost me if I were to go and try and generate that amount of income on my own? So as interest rates go up, that equivalent portfolio value dollar amount goes down. And so the company has a formula that they use and says, I needed to give you $1 million last year for that formula, but next year I only need to give you 800,000. So then your lump sum option just dropped pretty significantly, just because interest rates are different than they were last year. So we're nearing the year. And so for those people that are considering a lump sum option on their pension, or have those pension options in general, it's crucial to have a conversation about that, and make sure you have all the information that you need to make the decision that's in your best interest.
Again, something that probably doesn't impact a large number of people, but those that it does impact, it has heavy effects. It will be a
Yes.
big decision, and we need to understand that fully. Now, you did mention bonds, and I wanted to circle back to that because as interest rates have been on the rise, the New York Times had a recent article, Bonds Worst Year Ever. Forbes had a similar article the same week. Is this the worst year ever for bonds? This has been what has traditionally been considered the safer, more conservative side of an investment portfolio, but it has been experiencing an awful year. And because of that, more broadly, investors have experienced a very difficult year with their investment returns. So, what do we need to know or understand or maybe think about proactively if we've got a more conservative mindset and want to try to potentially protect ourselves from what the Fed has said it's going to do, continue to raise interest rates?
Right. So the relationship that interest rates and bonds have is a very important thing to at least basically understand if you are an investor, and especially if you are even moderately conservative or even moderate. I mean, this is going to affect everybody except for the most aggressive people out there. So it's going to affect quite a bit of people, especially those that are planning for retirement or in retirement, which is where we specialize in. So this is an important conversation that we've been having for quite a while now, and we're really seeing it in action right now. And so with this market, we're not just seeing the aggressive portfolios down double digits. We're seeing the conservative portfolios, moderately conservative portfolios. I mean, the whole gamut is down double digits in some cases. And that's because in just a real general sense, as interest rates go up, existing bond funds and bonds lose value. So that's the relationship they have. It's not a opinion or something that might happen. It is a mathematical fact that when interest rates go up, existing bond funds and bonds go down. They lose value. It might be a good thing in the long run for that type of investment, but in the meantime, there's going to be some issues and some volatility with that, and so that's why we're seeing the more traditional conservative part of a portfolio have some pretty extreme volatility, and it's lasted even longer than really the stock market volatility at this point in time, which understandably so makes people very, very uncomfortable because they had that part of their portfolio conservative for a reason. It was supposed to be serving a purpose of stability, maybe even generating income, which it's not really doing right now, and it's losing value. So that's really concerning to a lot of people, and it's very understandable. Yeah. So that's generally how interest rates and bonds, the inverse relationship that they have.
Yeah. Well, on the surface, we hear interest rates are rising, and in certain conversations, we may even hear the word improving, but rising interest rates have widespread implications that we do need to understand the impact and effect of. So, Abby, thank you for overviewing the different aspects of the financial world that rising interest rates will have an effect on, giving us a little bit of information and education on those factors. We really need to understand that this is the direction. The Fed says that they will continue moving in until inflation gets under control. And as a result, there are some predictable outcomes here. Whether or not we have a soft landing or a hard landing for the economy, and this does generate some recessionary kind of factors, maybe yet to be seen, but we need to understand that there will be some benefits from rising interest rates, but also maybe some significant challenges. Abby, we appreciate your time and perspective on this. And as always, If you have questions, ladies and gentlemen, about your financial investment, retirement plan, and portfolio, and how it could be impacted by rising interest rates, market risk, fees, taxes, expenses, you are welcome to be in touch with Abby Reed from the Retirement Family Reed Financial Group. Just give Abby a call at 687-442-0255. That's 687-442-0255, or you can visit online, goaskabby.com. Goaskabby.com. Abby, we always appreciate your time. Thank you for being here.
Thanks, Peter.
Here to answer your financial questions, visit the website goaskabby.com for show resources and to submit your questions and get answers, or to schedule your complimentary financial investment and retirement planning strategy session. You can also reach out to Abby directly at 678-442-0255. That's 678-442-0255, or at goaskabby.com.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM and Reed Financial Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. Third-party ratings and recognitions are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.